This is NBR Today. The High Court heard that evidence of serious impropriety, chronic insolvency and failure to comply with Reserve Bank directions were reasons to order the immediate liquidation of failed insurer CBL Insurance. In the end, the Reserve Bank's counsel, Nathan Gedai QC, didn't need to go into detail. Opposition to the RBNZ's liquidation application melted away on Saturday, and what was due to be a week-long trial turned into a brief one-day hearing. At its conclusion, Justice Patricia Courtney ordered the immediate appointment of liquidators. Kare Johnson and Andrew Greenfell of McGrath-Nicol, who acted as interim liquidators, will now have the task of maximising recoveries for creditors and pursuing any legal action on their behalf. The Mainzeal court saga continues, with the judge overseeing the case saying he will take into account the extent of Directors Insurance policy if he finds Dame Jenny Shipley, Richard Yang and other former Mainzeal directors liable for reckless trading. The four directors are defending the claim for $75 million. Justice Francis Cook said whether the directors were insured didn't have a bearing on whether they breached their directors' duties, but he was keen to explore what the policy will cover if he finds the directors must pay. The liquidators have suggested Mr Yan's investment in China Pacific could be worth $1 billion, based on their calculations derived from his evidence. Former Prime Minister Dame Jenny Shipley also has a family holding in China Pacific, though evidence was given that it's not immediately realisable. Finance Minister Grant Robertson has signalled the country's first wellbeing government budget next year will boost spending on mental health. He told Parliament the government can no longer track the country's success on a narrow measure of economic growth. But what is so different about the announcement to the government's focus in this year's budget on boosting family incomes and reducing child poverty through the Families Package? Well, National's finance spokeswoman Amy Adams thinks not much.
When these concepts were first put up to us, Treasury explained them as saying, well, it'll be good because it will enable us to enhance the quality of our assessment of budget spending. And that was music to my ears. I've got to say that the quality of government spending is something that I'm very, very interested in. I think that's something we as a country have to focus a lot more on, not just how much we can spend, but are we spending it wisely? Where are we wasting money? Where could we be more efficient? But when we drill down into it, the Living Standards Framework actually won't tell us anything about the outcomes of budget spending.
Mr Robertson will provide more insight into what the wellbeing budget will look like when he releases the budget policy statement and half-yearly economic and fiscal update on December 13. Question: how did a tech hub tasked by the government with pulling big data from global satellites end up in a quiet central Otago town that doesn't even have high-speed internet? The Centre for Space Science Technology was established last year in Alexandra to enhance innovation in regions outside the cities, aimed at educating industries on the benefits of using Earth observation data. This week, the centre launched its first international space mission partnership with NASA. The project, which uses data from the International Space Station's eco-stress technology, could predict drought, increase agricultural yield, and optimise forestry management. While the partnership is a win for CSST, it has been criticised by others in the industry who question what its role is, and the fact it's had a number of teething problems, including coping without high-speed internet connectivity, having to revise its business plan, and its head of research quitting after 6 months. CSST Chief Executive Steve Cotter says critics should remember it's a research organisation paid for work it does for the industry rather than be a strictly commercial operation. In Shoeshine this week, Jenny Ruth was gratified to learn that most, if not all, New Zealand-based fund managers don't own any AMP shares. But she says the AMP brand in Australia is now badly tarnished by revelations that it lied to the Australian Market Conduct Regulator, to ASIC at least 20 times, charged customers for advice they never received, and doctored an independent report. Meanwhile, its Australian wealth protection business has gone from reporting a $110 million Australian dollar underlying net profit in calendar 2017 to $61 million in the 12 months ended June. And looking ahead to tomorrow, the former head of listed aged care provider Oceania Healthcare is to launch a new retirement village group, which he hopes will stand out from the rest. So for more on that and other stories, head to our website and have a great evening.
To unlock your 2 free articles a week, head to nbr.co.nz.